We can see that the Fed began raising interest rates in March 2022. This marked the exact moment when the job market started to cool down. Because when the Fed raises rates, businesses face higher borrowing costs, which slows down economic activity. In 2021, businesses could easily take out loans at near 0% interest rates to expand operations and hire new employees. But by 2022, those opportunities dried up as higher rates made borrowing far less accessible and much more expensive. The risk today is that if the Fed cuts interest rates too quickly now, then there's a chance that businesses could ramp up hiring again, leading to more job availability and higher wage demand, the exact opposite of what's needed for lower inflation. But the Fed probably understands these risks and have recently changed their outlook on interest rates. You see, back in September of 2024, the Fed was projecting 6 rate cuts for 2025. But in the last meeting, Powell said that the Fed now expects only 1 rate cut in 2025. That's a big shift by the Federal Reserve that's likely caused by growing inflation concerns. So even if the Fed kept rates stable at elevated levels, it could help keep a lid on job openings, just like it did from May to August of 2008, when the Fed kept rates stable but job openings continued to decline. Such a scenario is possible today, which should continue putting downward pressure on wage growth and cause inflation to decline. And this downward pressure on inflation can be seen through something called supercore inflation, which focuses on price changes in services excluding the more volatile components like energy, food, and shelter. This metric is particularly useful because it highlights the most stable and labor-driven components of the economy, often a clearer view of underlying price pressures. By narrowing its scope, supercore inflation helps the Federal Reserve assess wage growth and demand-driven inflation more effectively when shaping monetary policy. This is what the chart of supercore inflation looks like. In early 2024, supercore inflation indicated a sharp pickup in inflationary pressures. For instance, the March 2024 reading showed a 5% increase, which is a very high number compared to the past decade. This showed sticky inflation, suggesting that inflation was particularly stubborn at that point. Since then, supercore inflation has cooled down, dropping to around 2%. So for now, not really telling us that we are seeing a sustained inflation wave. But the outlook still remains uncertain. Yes, inflation has been cooling for the past couple of years. However, there's no guarantee that this trend will continue. And one of the big reasons for that could be Donald Trump's tariffs. Tariffs can drive higher inflation by raising the cost of imported goods. When that happens, businesses typically pass at least part of the increased cost onto consumers through price hikes. So in other words, causing inflation. There is some debate about the connection between tariffs and inflation. Some economists argue tariffs only cause one-time price increases, but not sustained inflation over time. And inflation remained stable during the flurry of tariffs during Trump's first term. Trump just doubled tariffs on Chinese imports to 20%, and he's also been promising and repeatedly delaying 25% tariffs on Mexican and Canadian imports, which could come fully into effect in the near future.